Hi there. Thanks for tuning in. Today we're going to be doing an analysis and valuation of Dover Corporation. Just to get into who they actually are, they're a manufacturer of industrial products, they're a conglomerate, and they're pretty big right now because they've been since 1955 just acquiring a lot of companies. Right now they're divided into five segments: engineered products, clean energy and fueling, imaging and identification, pumps and process solutions, and climate and sustainability technologies, and that's what sort of all their information is broken down by. And yeah, they're part of the S&P 500. So let's look at some numbers about them first and foremost. So when you look at Q2 2025, if you look at their investor presentation where I'm getting this from, they're saying, oh, well, we did pretty decent. We have some organic growth going here. Bookings are up. Our EBITDA is up, basically. And our guidance is pretty optimistic. The revenue is going to grow between 4 to 6%. And the commentary here is driven by secular growth exposed to end markets, strong order trends, and margin conversion. So they're keeping those margins strong, basically. And all their segments seem to be doing better, which is pretty cool. Lower volumes in vehicle services partially offset by growth in aerospace and defense. So you see they're exposed to different markets here. It's not just, for example, that they're dependent on the amount of car sales. It's also many things going on. Lower shipments in textiles, sure, but also pharma, single-use biopharma components here where there's robust shipments. So even if one of those segments suffers, others should be able to pick up the slack unless there's just an overall recession that brings everything down. But even then, there's some secular trends in products such as pharma where those are not that optional, even in a recession. So far, a lot of growth, doing pretty decent, right? Now, with the free cash flow so far, which is so nice that they include the year to date free cash flow here, they basically are improving the percentage of revenue of free cash flow that they have, which I love to see this at the end of the day. Sure, a lot of it comes from depreciation and amortization, but that's fine. That's still the amount of actual cash that they have in hand at the end of every period. And as long as this is improving, we as value investors enjoy seeing that and can reap the actual rewards of whatever they do with that cash, be it issue dividends, be it buy back shares, make acquisitions, just reinvest in growth. That's all great and fantastic. Now, their momentum, apparently it's continuing all throughout. And you can see the different sort of reasons here, right? The growth in biopharma, the polymer processing is down but improving. There's a growth in CO2 heat exchangers. So lots of different products that they're exposed to here. And if you want sort of a bigger piece of the American manufacturing pie, it seems to be decent. Now, they still go through negative periods here. They can go through negative sustained periods, but also they go through good times as well. Their full year guidance is also just everything they're saying is going to be up. So that's something that's were you to do a quantitative model like I'm going to do later in the video, you would just sort of account for these sorts of things. Good to know as well. And they give you all of this stuff. So what free cash flow percentage of revenue is going to be 14 to 16%. That's very optimistic. I'm not going to be doing that number. I'm going to be doing something more conservative. But before, let's look at the margins. I mean, as you'll see, revenue growth is not consistent for this company. You have -10, -13%, followed by +13%, basically. Few years of slow growth. 2020, it was down for obvious reasons, then monster growth, and down a few years. Now it's up a few years. So there's some cyclicality here that's important to note, of course. But look throughout all that cyclicality at these beautiful margins where the gross margins are very consistent at this 37 to 38% bound. The operating margins, 13 to 15%, super consistent. The return on invested capital, pretty much double digits the whole time and improving. So we love to see these things. That shows you that it's a company that may end up being robust even in the worst of times because at least the margins aren't compressing and they can take further advantage of it in the best of times. Now, I'm going to do a quantitative model. What's going on here is simply I'm plugging in these numbers. I'm starting at that baseline where they're saying our percentage of revenue that we're going to grow by about 7% of that is going to be turned to free cash flow. Okay, perfect. Roll with that. And so have free cash flow for next year of $562 million. And then we're growing that little by little. I'm saying that these margins are going to improve. So this year is going to be 8% of revenue, 9%, 10%. And then we're going to have a perpetual growth rate there of 3% for their revenue. Okay. Now, My required rate of return is 11%. That's 1% more per year than the market. And my perpetual growth rate is going to be 3%. I think it's realistic to say that this company will roughly grow at 3% in perpetuity. And if we divide this by the total number of shares out that this company has, it's $71.08, which is what I think the value of each share should be worth. If we subtract the net debt, of which they don't have a ton, you would get a value post debt of $57.92. Now let's see what Dover is actually worth. And wow, I mean, it's not even close here. It's much, much more here. It's $172.98 as of, well, when I took the screenshot on September 12th. A P of 10, though, pretty low here, a dividend yield of 1.2%. You take that information as you want. If you care a lot about P, it may look undervalued to you. If you care a lot about cash flow generation and you want to be a little more conservative, perhaps you are a little more conservative too about the manufacturing sector. So I just think analyzing this company, there's a lot of things to like and perhaps some things to not like. So things that I like, for example, is that the margins are fantastic. Even in downturns, the business just looks so solid. That segment diversification paired with share buybacks, a small dividend, it's actually a dividend king, should help drive some shareholder returns no matter what. And then a simple, solid, boring company is often a very safe investment. I understand very easily how Dover makes money, right? I understand the different segments. I understand sort of what industries it's selling on, and I understand that it has a diversified sector or a diversified pie of industries that it is selling its products to. Things I don't like, however, are the amount of goodwill in the balance sheet, which is massive. It's about $4.5 billion. And if those acquisitions don't prove to be as valuable as they say they are, they'll have to write that down. They'll take a hit in the profits by writing down the goodwill. The absolute valuation here, while very conservative, honestly, this valuation, you could add many, many dollars to it. That's why I am saying do your own model as well. If you think my perpetual growth rate is wrong or I'm being too harsh on the percentage of revenue that they're going to turn to free cash flow, well, still to me doesn't match up to reality. But maybe they're not as overvalued as my model shows. But here's the other things. With tariffs, honestly, who knows where things go, right? If the purpose of tariffs is to revive American manufacturing, it may work, or it may just have plants close because all of a sudden people are buying less American products. And yeah, who knows, honestly. So it could backfire. Dover could have a bad time because the things that they export all of a sudden aren't being bought or sought after as much. But if you have certain products that maybe require high technical know-how and maybe are only manufactured in the US, then you could have some things that simply cannot be replaced. Plus, also something to note is that the stock tends to crash pretty hard during bad times. I mean, in 2008, it was down 50%. In the 2020 pandemic related crash, it was down 50%. Between 2022 and now, it was also down by a significant amount. So, as you can kind of see here, so it's possible that it'll just go down again, and that's one of the reasons why I'm just going to say keep it simple and buy in downturns. Keep it simple with what? Companies that you can understand that you can genuinely explain how they make money and how much of that is turned to cash flows and then buy those in downturns, based on whatever metric you want. You can say when it goes below this amount in a certain downturn, and if I'm still confident in the business inherently here, I'll buy it. Dover is something that maybe based on my model I wouldn't necessarily buy today, and yet I would keep it in a watch list very closely and buy it the moment there's a downturn, because I know for a fact that with the consistency that they at least have in margins and cash flow, that a recovery will be pretty decent. Now, thank you so much for watching. That's all for the video. But if you like stuff like this, please comment. Let me know what stocks you want me to look at, and let me know what you like, what you didn't like, if you have any feedback. And thank you so much. Don't forget to like and subscribe, and have a great rest of your day.